it's only a function of how high does the market go and how long does it stay there, or how low and how long. So it's high, how low, and for how long. And that's the only argument that we can make is, the recession will come, or there won't be a recession, or it'll last for a long time, or it'll be quick. Sure. But the markets always cycle. And if you don't understand that, then you're probably just going to lose money. But markets always cycle. There's no question of that. It's just.
Welcome to The Real Deal, a commercial real estate investing podcast. I'm your host, Aman. There's a ton going on in the world right now, and much of it impacts real estate investors. The Real Deal podcast will take a look at what's happening and how it influences you as a real estate investor. Each episode is a 20-minute segment dedicated to distilling the day's most important news, so you can stay up to date on what's going on in the world and how it might affect the commercial real estate market.
Welcome back to another episode of Cashflow Capitalist Show. We have a very special guest today from the very first episode to today, Bill Ham. Hey, Bill, welcome to the show.
I appreciate it. Thanks for having me back. That's right. I was your very first episode. I remember. Yep. It's good. It's good.
So give us a 30-second introduction, who you are.
Sure. Yeah. Bill Ham, and I am a multifamily owner operator. I have been in the multifamily space like 20 years at the end of this year. Mm-hmm. So built a large portfolio of multifamily properties starting from a duplex back in 2005. I was a pilot, quit my job, went into real estate full time with a duplex. Built a large portfolio over the next 20 years. Have done a lot of creative financing, a lot of syndication, made a lot of money, lost a lot of money. I've had deals go good and some go bad. And I have been through all of the market cycles, all the ups, the downs, and then back up again. And so I'm pretty familiar with how the market moves, sort of what to expect and what's going on.
So you mentioned market cycles. So what are the market cycles? How does it affect the economy?
Well, there are, when we say market cycles, really what we're going to discuss are the four business cycles, 4 cycles of business. And so just imagine kind of a wavy line, right? Yep. And as the line goes up, that's your expansion cycle. You get up to the top there, that's called your peak cycle. Then you have your recession cycle, trough, and then expansion again, right? And so those are your 4 cycles. It's up, across, down, bottom, basically it, right? So now we can apply those 4 market cycles to almost any kind of business, real estate. And then even inside real estate, we could talk about storage or hotels or office space versus multifamily space. They all cycle differently. So you have these cycles that are sort of national economic cycle, and then you have maybe stocks or real estate or different areas, and then even inside those you can have smaller cycles, but all follow the same pattern.
So how important it is for investors to understand these market cycles, and what can they do to make smart choices for investment?
Yeah, it's incredibly important to understand market cycles. If you don't understand market cycles, and that's in any kind of investing, whether it's stocks or real estate or bonds or whatever, you have to understand how the market ebbs and flows, and it moves and comes back to you. And market cycles usually, especially economic or in real estate, are about 10 years. Yep. So we're not talking a few months or a few years. It can be 10 years, sort of peak to peak, trough to trough. So yeah, you have to be very careful following the cycles. What I would tell everybody, and one of the main reasons that it's so important that we learn market cycles, is because it's technically an inflation cycle. And that's really at the end of the day, and that's what I've learned over 20 years of real estate, is that these cycles and the things that make markets move is really debt. In debt, we're calling debt the availability of funds in the U.S. system. So if the government is putting more dollars into the system, you have more money floating around, which is inflation, right? And so if they put too much money into the system, like we saw through pandemic and lockdown, all the stimulus money, you create hyperinflation. All right. Well, then the offset to inflation is the rates go up. So they raise rates. Raising rates then suppresses the market back down. Yeah. If we're discussing like real estate, it just makes real estate more expensive. If real estate's more expensive, then it kind of makes the value down, so forth and so on. So it's really just a cycle of inflation. And that's what you got to learn, and that's what you got to watch. And the reason that's so important is because the direct translation is rates, and that affects everything.
And so what's the average length of each cycle? And
10 years, 8 to 10 years, right?
Eight to
So
10.
from top to top or bottom to bottom, peak to peak or trough to trough, you're probably 7 to 10 years. So I would say a section of a cycle. So if you're up at high, like we kind of are, and I think we're kind of starting to come down, you're probably 3-4 years down, and then you may level off the bottom for a year or two, and then, a few years up on the other side. It's not really an argument of whether market cycles exist or whether they do or they don't come. It's only a function of how high does the market go and how long does it stay there, or how low and how long. So it's how high, how low, and for how long. That's the only argument that we can make is, the recession will come, or there won't be a recession, or it'll last for a long time, or it'll be quick. Sure. But the markets always cycle. And if you don't understand that, then you're probably just going to lose money. But markets always cycle. There's no question of that. It's just.
And if you talk about different microcycles, what market cycle investors should focus on to invest, and when he or she should sell the properties?
Well, yeah, it's not that straightforward of an answer. I mean, if we're just going to talk straight market cycle, then you buy everything when the market is at the lowest and you turn around and you sell it all at the high. I mean, ideally, right?
Ideally.
But I'll tell you, trying to time a market like that is a mistake. You're going to get it wrong. I'll just say right now, because the only way that we can ever tell when a market has peaked or is peaking is when you look back and go, there it goes. There goes the peak, right? It's always in hindsight. You can never say exactly when it'll occur, when it won't. And what I have found, and mistakes I've made personally, is trying to time the market too closely and then actually missing deals. Because then you start going, the market's going to go to the top, the market's going to do crazy. And then you kind of start pulling back, and then you stop doing deals, and then the market goes on further than you thought, and now you've missed out on some deals and things that, so stuff like that. That's I'm out of focus now. So that's where I would say, really, you want to kind of learn your market cycles. It's recession cycles, it's inflation cycle. Watch that, and then you have to, if we're talking real estate specifically, then you need to overlay your debt piece onto the market. So this is what I think has occurred in the multifamily cycle, is that people have not been paying attention to terms, loan terms, right? Length and type. And they went out 2 years ago, 3 years ago, getting a lot of short-term interest-only bridge type debt, variable rate loans, things like this, because at the time that money was very inexpensive as far as rates and things
like
are concerned.
2%, 3%.
Yeah. And I kind of warned everybody. I said, but look, watch your inflation cycle. We haven't seen interest rates go up in years. So chances are they're going to. Well, then on top of that, we had the COVID and the stimulus, which really kind of just hyper exaggerated that scenario. But now people went out, got short-term 2-3 year IO interest only short-term loans that are all now coming due October, November of this year. And so that's what's happened. And so now these people that went and got these loans at 3-4% interest rate are having that debt come due. And that's what we call maturity exposure. So they're having maturity exposure now at 7.5% interest rate, from 3.5 to 7.5 is major. And that basically means you would have had to have double or triple the revenue of your property to be able to keep the numbers matched to the interest rate. That just didn't happen. And so I think we got a lot of distress coming October, November this year.
And the odds to do that are slim to none. And if you talk about, you said buy low and sell high, that's ideal situation. And if we see in COVID, it was very expensive. Everybody was buying and buying and buying. And some people also sold more expensive than that. And some people are still facing the mistake they did in the past. So what do you think, where are they standing at this point?
Probably going to go into foreclosure here soon or sell or whatever. It really depends on how long of a loan they got. So, and this is what I call the 3 pillars of real estate. And then I wrote about this in one of my books, but you have to understand debt, exit strategy, and market cycle. Those are your 3 pillars: debt, exit strategy, market cycle. And if you can line those 3 up, you greatly increase the chances of you being successful in real estate. What we're talking about here is these people weren't really looking at the exit strategy. They were just thinking, we'll just buy and hold and refinance or operate into the sunset. And they weren't really paying attention to their exit strategy. And then they went out and got short-term loans, not thinking about those rates coming due. So the answer is, it's hard to say exactly where this is going to work out for everybody. I think the people that got short-term loans are facing a lot of maturity exposure, they're going to have a heavy rate reset. And they may have capital calls. They may have, if they're syndicated deals, they may have liquidity that needs to be brought to those deals in order to survive. If you got long-term debt, and this is what I mean about debt being one of those third pillars, you have to be able to time it with the market cycle. So if 2 or 3 years ago you went out and got a 10-year Fannie Mae, Freddie Mac, loan, you're good. Don't worry about it. Yep. And that's the greatest thing about multifamily. It cash flows. You just cash flow. You just keep operating, keep doing your job. And even if the value crashes tomorrow, so what? Don't sell. Just keep cash flowing, do your business, and don't worry about it unless your loan comes due. See, and that's why I say that's one of those 3 pillars, because if your loan comes due, exit strategy, and you're in an off cycle like you're about to see a lot of people face, then you're violating the 3 pillars, and you're gambling at that point. You might make money, but you might not. And one thing I've come to realize in real estate is you never want to be a motivated seller. Yep. You never want to have to sell. If you have to sell, you're probably going to lose money. Yep. So you have to time your sale to where it's when you want to sell, not have to sell. And so I think that's what you're about to see is a whole bunch, around $4 billion worth of short-term loans that are going to have to sell right around October, November. Yep. We'll see where that plays out. There's lots of theories as to how that's going to turn out. We'll see.
And also, these operators were hoping we can keep those interest rate low. The Feds are going to keep the interest rate low. Hope is not a strategy.
Yeah, exactly. Well, they didn't. They didn't keep the rates low. They didn't. Now the only other hope a lot of these people have is what we call extend and pretend. That the bank will just kind of extend the loan and pretend like the rates didn't go up or their debt service is bad. What I think you're going to see is a lot of liquidity needing to be injected into these deals to right the financial ship. And what we're really discussing is debt service coverage ratio, the ratio of net operating income to loan payment. And that number is going to go bad. And people are going to have to bring money to the table to lessen the loan amount. And so we're going to see a lot of cash out refis that turn into cash in refis. All these people that we're talking about the Burr model, buy, renovate, refinance, run off, whatever that is. And they were going to go and buy these deals and make all this money. Well, when they go to the refi, they're not pulling money out. They're going to be putting money in. Yep. And that's what you call capital call. And so I think we're going to see a fair amount of that coming into this year. Q3, we'll see. Q4.
No, and I even remember that when we met on MM5. So I spoke to somebody else. We underwrote the same deal. I remember I put the offer for 12 million. They were asking 14 million, and they end up selling for 9 million.
Yeah, right.
And I know who owned the property, and I don't want to mention any names.
And, it happens. And I, who knows, fella out in Texas again, won't say names, but the fella went out and bought 7,000 some odd units in the last couple of years and went into foreclosure with, 3,500 of them, just recently. So that's a big up and a fast down, 7,000 units in a couple of years is absurd. But again, I think this guy probably, I think he cashed a lot of acquisition fees. Yeah. That's what he did.
So in the last 2 or 3 years, we can understand that we had a COVID. So there was no money in the market. People were not working. So they had to bring stimulus. They had to lower down the rates because nobody was buying. What are the other signs we need to keep that in the future in our mind that we can focus on timing the market, that we can at least save ourselves?
Yeah, right. So we're going to have to watch the rates. That's one big one. Attitude about real estate will be another one. I think we're going to go into a tough borrowing world for some years where you will see a lot of creative financing become more prevalent, lease option, seller financing, things of that nature. And so I think that's what you need to watch. What I would tell people to kind of be safe is to go out and get newer buildings. Okay, so number one, just be very careful about older assets. And I'm saying older stuff in the 1960s and 1970s. Be careful about those because they just got a lot of repairs and maintenance that need to be done. So I'd say that's one way to protect yourself. Number two, don't overpay. Don't speculate on deals. You don't want to come in here and say, well, the deal is a terrible deal, but I'm going to raise the rent. And then as soon as I raise the rent, $1,000 a unit, then it'll be a good deal. I see a lot of that where the realtors are telling us, hey, raise the rents and then it'll be a good deal. I would be very careful about speculative buying over the next couple of years. Don't reward the seller for doing a bad job. All right. So you need to underwrite that deal and you need to sell or offer a price that allows that deal to cash flow day one with your offer right there. Not pro forma, not raising the rent in the future. We got to stop all that, be conservative, and stop overpaying for real estate. If you'll do that, you'll be fine. You'll be fine. But you know what? If you'll do that, then market cycles don't really matter, do they? Because you're buying good deals all the time. And that's where I say this is all kind of, it is important. Market cycles are incredibly important. They are. If you stick to the fundamentals of buying real estate, the math, the income ratios, things like that, you really lessen a lot of the risk of all of this. It's when you get into that speculative valuation, that's where you're going to get in trouble.
And if we talk about today's time, we are on the peak of the cycle we're on the below, right? And is it a time to buy with a long-term debt or a short-term debt?
That's a really tough question to answer right now, because I would say technically per the cycles and what I'm telling you, the answer would be long-term debt. Oh, you want to go out and get long-term debt so that, you can kind of ride it out. You don't have to worry about the values and all that kind of stuff. Yes, but if you go and get long-term debt today, you're locking in the highest interest rates you can possibly come up with for long term. The issue, and then people think, well, I'll just refinance when the rates go down. Well, hold on. Long term debt, agency debt, Fannie, Freddie, CMBS type loans come with a lot of prepayment penalties. And that's a structure that a lot of people don't understand. Defeasance, yield maintenance, some of these things. And it means that you're not likely to be able to exit that loan and pay the loan off like you think without paying a ton of prepayment penalty. So this whole refi in a couple of years and lower the rate is not very likely to occur. So it's hard to say. On the rate conversation, I'd say you probably want shorter term, lenient debt you can get out of in a year or two if the rates go back down. But at the same time, if they don't, and the rates kind of stay where they are, you're exposing yourself to the same problem that has happened over the last 2 years. You're getting short-term loans when the market is too volatile. So I would say, I guess the 10,000 foot answer, easier said than done, would be get longer term debt at the right price and get properties at the right price and get longer term debt. Don't overpay for the real estate. That's probably going to be hard to do before October, November. I just don't think, I think a lot of these sellers, they pay too much themselves.
And what kind of DSCR they need to keep in mind? Because I think we have interest rate up to like 5 or 6%.
Yeah, 1.25 is the magic number. You always want to be at a 1.25 debt service coverage ratio, meaning for every dollar of mortgage payment, you want to see about $1.25 in net operating income, right? So income minus expenses equals NOI, net operating income. There's your ratio. So I'd say, about $1.25 is, or 1.25 ratio is pretty good. Most lenders will do business with you and refi at that number. And that's also a tip if you're looking to refinance a property and you want to ask yourself, well, how much money can I pull out of this deal? It's easy. The answer is a 1.25 ratio's worth. So all you have to do is kind of put in today's interest rate, and then you just adjust your purchase price until you get a 1.25 debt ratio at today's interest rate. And that'll give you an idea about what your property is worth if you were to refinance it, right? And that's back to where I say a lot of people were thinking, hey, we're going to refinance, pull money out. But they raised the rent, just like the realtor said, and that's fine, which the debt service ratio went up. And that's great. And their business model worked. But then the Federal Reserve raised the interest rates and their debt ratio went right back down. So they raised the rent some more and the ratio went up. And then the feds raised the rates and then the ratio went back down. And they're stuck on this rate treadmill, constantly trying to decompress that cap rate or debt service ratio. And the feds are looking at what they're doing by raising the rent as inflation. And so you've literally raised the rents into rate raises, and that's what's occurred is the rent is paid into these rate raises.
And who's suffering more? Consumer.
The consumer always does. Yeah. In the short term, some of the owners might take a pinch. Long term, the cost is always passed to the consumer. We know it is. Yeah. But in the short term, and here's again why I kind of say you got to worry about market cycles. The cycle can move faster than your ability to transact in multifamily. Mm-hmm. The cycle can come and go faster than you can get in or out of a deal sometimes, and you can get in trouble. So that's where I say you got to be careful about what you buy and what you pay for it. As long as you stick to the math, you'll be fine.
And for long-term debt, what kind of how do I say, like the period of the debt maximum they can take, anybody can take, like 10 years, 12 years, 15 years? Is there any limit for that?
There's no the longest term loan I've ever heard is like 30 years, but that's rare for commercial. But yeah, there's no law or anything like that. So I mean, somebody could give you whatever loan they wanted to. What is standard, I would say, is probably long-term debt. We're talking 5, 7, or 10 years. Short-term debt, I would say probably 2 to under 5, 3, 4 years around that, which would be shorter term for just conversation.
But if somebody take the long-term debt, they can sell anytime when the market is better.
They could, but again, see, that's where I say you gotta be careful, because retiring the debt, if you want to pay that long-term loan off, it'll come with a big prepayment penalty. But that's also where and again, we could go way off into this conversation, but that's also where we get into assumable mortgages, right? Most of these mortgages that have big prepayment penalties are also assumable, meaning a buyer can just step in and take over the loan. So you don't technically have to pay it off. But refinancing and keeping the asset, that's where everybody makes a huge mistake. You can sell if somebody will assume the mortgage, yes, but if you think you're going to go get a 10-year Fannie Mae loan and then refinance in 2 years and pull all your money out, you've made a terrible miscalculation, because you've got a tremendous amount of debt service, or not debt service, the yield maintenance that would come due, the prepayment, and it would take away a fair amount of the profit from that. And that's where I see people in their underwriting make that mistake. We're going to get a long-term loan because that comes with the lowest interest rate. And then to get the returns better on their perspective, then they say, oh, we're going to refinance in 2 years and pull all of our money out. No, you're not. Not with that loan, you're not. So you have to have that kind of, again, debt, exit strategy, market cycle. You have to have an understanding of those.
So the prepayment payment penalty, does it come with like step down, or just it stays up to like for 5, 7 years, something like this?
Depends is the answer. Yes. Typically it lessens over time. Now, how it lessens over time it depends, right? You can do a step down where it drops down incrementally the percent of the loan amount each year. You might have more like yield maintenance, where it's almost like an interest rate guarantee. You're guaranteeing that this loan produces X amount of money in rates, and somebody invested in that. So it's yield maintenance. There's different things, but yes, typically speaking, as you move closer to the loan payoff, the original loan payoff, yeah, that debt service is lessening over time. So if you go get a 10-year loan and want to refinance in 2 years, it's going to be at maximum. If you refinanced or sold with 1 year left in the loan, it'd be at a minimum.
Got it. So what if you talk about capital call? What is a capital call? If you like
capital call, that's a dirty word. Oof, we sure want to talk about that?
It's a very dirty word. I heard about this very dirty word.
That's a dirty word. We don't want to hear that. Yeah. All right. So capital call, typically in a syndicated deal, and all we're saying is when something has gone wrong with the property and the general partners of the deal have to reach back out to the investors and say, hey, we need more money. Usually this is going to be because the loan is coming due or something like that, like we're discussing right now. And the bank says, hey, for us to refinance the deal, you're not pulling money out. We need you to put $100,000 in. We need you to add $200,000, and you were planning on refinancing and pulling money out. You now need this extra $200,000 to refinance the deal. You're probably going to call those limited partners up, your investors, and you're going to say, hey, everybody, we need more money. And if you don't give us more money, you're essentially going to lose your original investment. Now, I'm more or less paraphrasing, and every deal is different, but that's a capital call. It's in calling up your partners and saying, hey, we're short of money. Everybody get out your checkbook.
So the question is, you said if investors don't want to give their more money, then they can lose the initial investment. But if they cannot give the more money?
Okay, now see, that's a very specific scenario. So generally what I mean is if you don't give us more money, you're going to lose your money, probably means that you're going to go into foreclosure. That if you don't invest in this deal, so we're not it's not like a threat or holding your money hostage. It's just like, hey, if we don't take care of this situation, the deal goes into foreclosure. You invested in the deal, and if we go into foreclosure, you lose your money. So that's all I meant there. Now, what you're asking is a little bit more legal and specific question. Yes, in some paperwork, PPM, private placement memorandum, the document that says this is what the investment is, and the investor signs it, inside there in the fine print can say, yeah, as an investor, if the general partner calls you up and says invest more money and you don't, then they can nullify your original investment. Now, that's specific to each deal. You would have to read your own PPM, and I'm not saying that's your deal, and I'm not giving anybody legal advice, but that's what's inside. That's the PPM. So you have to go read that. And yes, a lot of PPMs state that if you don't, pony up this money, you're going to forfeit all of it. So yeah, that's
But PPM is a large document. Nobody reads it.
I can't disagree with that comment, right? Or I will add to that comment. People tend not to read them until they're angry. And that's bad, right? People, when everybody's happy and everybody's getting into the deal and blue skies and all this kind of stuff, sure, nobody reads those things. Everybody's like, oh, I know, these guys, they're great. I don't write him a check, man. This is, yeah. And then all of a sudden, Bill and Aman do this deal, and it doesn't make as much money as they thought. And now they're kind of calling up and going, "Hey, we need some more money." That's when the investor goes, "Wait a minute, what's going on here? What did I invest in?" And now they're reading the paperwork. Now they're calling up an attorney to read the paperwork, and that's the wrong time, right? So if you're a general partner, you really want to try and make sure your limited partners are as educated in your deal as you possibly can. Be as clear as you can, and communicate as much as you can to protect yourself, right? Hey, limited partners, no like and trust is not good enough. You guys got to stop doing that, right? If you're a limited partner, you want to invest in a deal, just because you know and like somebody who has a podcast is not good enough. You got to understand the math. Yeah, you got to understand the underwriting. So stop that as an LP. Stop running around handing people money that you just met at a boot camp, right? You got to know them better than that, and you got to understand the math. So that's my opinion on both sides, GPLP.
So what can a GPs do to avoid the capital calls?
Don't pencil whip your deal. Don't. Motivated buyers typically become motivated sellers. I'll tell you that. You know what I mean? So people that typically run around chasing acquisition fees and getting into deals where they are underwriting in a very egregious manner or lenient manner and things like that. Yeah, as a GP, you've got to avoid that. As an LP, again, same answer. You got to know the math. One of the big things that would concern me the most these days is a general partner wanting a big acquisition fee at closing on a deal that isn't cash flowing today. Now, if it's going to cash flow, in a year, 2 years, something like that, okay, fine. But why aren't the general partners taking their acquisition fee when you're getting profit in year 2? Or you think, why are they getting their acquisition fee at closing, but you're getting cash flow in 3 years? Like that would concern me. So that's something I would watch for right there, because I'm investing in an investment. I'm not hiring employees, right? And if they're being paid up front at closing and I'm taking risk of making money and they're guaranteed money, that's a job. I'm hiring them basically. And that I don't like that. So those are just some things I would be careful for. I see in the market right now.
I think that's what we saw in the recent news from Houston, the foreclosure, I think. So that's where they were stuck in that wrong market cycle, wrong debt, no market cap. They had no idea what was going on, no rate cap, nothing. So they just bought it. Now they're like $200 million foreclosure. And I also heard about they left the country.
That is also something I've heard. I don't know if that's true or not, but I know the individual was a dual citizen and certainly could have left the country. I cannot confirm nor verify that comment, but I have heard that as well.
I'm not sure about it, but he's nowhere to found.
I am not surprised. That's all I can say to that. Yeah.
But yeah, let's see where we are taking our whole market. And if you talk about recapitalization, what is recapitalization?
Recapitalization would be like refinancing the property or restructuring the debt. It's a very broad or general term or topic, but recapitalizing would be restructuring the capital in a deal, and that could mean lots of things, from selling and perhaps taking a loss or a discount on the price to a refinance, things of this nature. And yes, in this recapitalization is where I think we're going to see a lot of issues going forward, because as I'm saying, there is not enough equity or liquidity left in a lot of these deals for the lenders to continue to finance them in the manner that they have. And so you're going to see a lot of recapitalization where there is going to be a lot of equity brought to pay down debt. And that's what I think where the recapitalization conversation we're going to be having. Again, it goes back to this red October. We keep talking about October, November of this year, with over $4 billion, a record amount of multifamily debt coming due, all within a 60-day window. This is a very concentrated amount of time with a lot of loan maturity in that 2-month window.
I think we have a topic to talk about this in October and on MM6.
Yeah, there you go. We'll be there.
So I'll be there too. And does refinancing also comes under recapitalization?
Yeah, good. Yeah, absolutely. Yeah.
So if somebody have a good 30-40% equity, they can refinance and from bridge to pull, or maybe they don't want to pull out because the market is where we are standing, or they want to have like 30-40% as a LTV. What are the equity they have now? They can just refinance to a long-term loan. Is it possible?
Yeah.
Or where are
Yeah,
bank
absolutely. Yeah, if you've got the equity, yeah, you could. Mhm.
and where are the banks standing?
All right. Well, again, 1.25 debt ratio. It's always that answer. The banks are not lending less. And this is, I think, kind of a misconception. They are a bit more conservative these days, but the banks are always typically lending around a 1.25 debt service ratio. The catch is you've started paying more and more and more and more for the same amount of revenue, which is lowering the debt ratio. And so basically the banks are saying, hey, we'll lend you 80% of the purchase price at this debt ratio. And if you want to pay more than that, not a problem. We'll just lend you 60% of that. And if you want to pay even more than that, not a problem. We'll just lend you 50% of that. So what the bank is essentially communicating to us is, hey, we don't value the property the same way you are. And if you want to pay that price, that's fine. We're just not going down that rabbit hole with you, right? We're just not going to cover that value. So if you want to pay too much, we're still at a 1.25 ratio. So that's where you're seeing what seems to be the appearance of lending and more down payment. Not really. You're just paying too much for the real estate. You just keep chasing price. And every time you're doing that, you're keeping that debt ratio at the same. So what I'm really discussing is cap rate compression. As long as we see cap rate compression, right, people paying more and more for the same sort of stream of cash flow, you're going to have this issue, right? Time solves that. So if we hold prices level, which I think we will see for a while, if prices stay level and the rent over time rises, then eventually the properties go back to being worth the right value. But that takes time, and it takes holding those assets. And that's where I think a lot of people are not going to have the hold period to be able to get all the way to the end.
But I think I also saw some lenders in the last 2 years lending for 1.1 DSCR.
And then you can, and in the 1.25, I'm saying it's just a rule of thumb. It's not a law. It's just a very common debt service ratio is 1.25 with most lenders. Yeah, you may see some go below 1.25. It's a rarity. They don't usually do it, and they don't usually stay there for long. But who knows? Right property, right price. You probably a right borrower. You probably get that.
And we also saw some banks are failing in the past, and majority of their portfolio was in commercial real estate.
Yes, in crypto.
And what comment do you want to make about that?
Well, yeah, really and truthfully, that's market cycles. And the long conversation, but the banks were exposed to the violation of the same 3 pillars of real estate. The banks were forced to become sellers. Now, what were they forced to sell? Their bonds. Right. And that's the way the interest rates work. Right. You bought a bond and the government set those rates back a few years ago. So maybe that bond was paying 2%, 3%, whatever. Right. And now they're issuing bonds at a much higher rate, let's say 5%. Well, that suppresses the value of that original bond, because why would I go pay you a face value of what you pay? Right. Not a problem. Because a bond can just be held until maturity, right? It's a government IOU. And you give the government money, and in 10 years, whatever, they're going to give you the money back. It's an IOU. Fine. As long as you, just like a mortgage, right? It's the same thing, basically. As long as you don't have to sell, market cycle, and that's what I'm talking about, then you're okay, right? So if something in your real estate deal makes you have to sell, loan comes due, capital expense items, capital call, any of these kinds of things. Or let's say the feds raise the interest rates and that suppresses the value of your bonds, which is more or less what happened to the bank. They reported the drop in the value. People got nervous. They started pulling their money out, making withdrawals, which made more people nervous, which led to a run, so forth, so on. But the underlying issue is they had bonds that went down in value and they were forced to sell. And it's the same exact lesson as in real estate. You got to pay attention to what you're investing in. You got to understand your market cycle, debt and exit strategy. And if you don't, you're just adrift to the market. When it's up, you're going to be up. And when it goes down, you're going to go right down with it. If you want to stay here, for longer, you want to be here for 20 years, You got to be able to ride all the waves, not just the up ones.
But I also saw some people are buying because just for sake of they want to buy something for the investors.
Right. And those are the people who are typically getting acquisition fees. They were becoming money raisers, not real estate investors, not operators, they were just syndicators. And what they were syndicating was almost irrelevant to them. They didn't care. As long as they got an acquisition fee, as long as you invested in the deal, as long as whatever, all the rest of it was irrelevant. Whether they'd operate, whether the rates would go up, whether they'd go into foreclosure, nobody cared. Why? Because they didn't cover that in that guru class they showed up to. That class just told them how to go get an acquisition fee. Didn't tell them how to be a real estate investor.
And how are you changing your underwriting today?
I'm not really. Same underwriting I've always had. I know what a good deal is. When I see one, I'll buy it. It doesn't really make much difference to me what's going on in the world. The only difference I'm having to really do in the underwriting is lowering the price. That's the main thing I'm doing in my underwriting, is just lowering the heck out of the prices and making low offers. And then they tell me no. And I say, okay, fine. I'll call you next year, first quarter. We'll see how it goes. But lowering my offer is about the only change in underwriting that I've really made.
And how are you sourcing deals? Are you making any changes
the
in
same
that?
way, there's only two ways to ever source deals. It's easy to answer. You're either going directly to an owner or you're working with a realtor. There's no other choice. You're talking directly to owners, you're talking to realtors. So I'd say the majority of the time I'm sourcing deals through realtors, relationships.
Got it. So before we wrap this up, I have a couple more questions. So what advice do you want to give to somebody who's starting new in real estate?
Yeah, if you're brand new and you're starting to get into real estate, two comments. One, check out my website with a bunch of free material and articles at realestateraw.com. My real answer is go out and spend your time and your energy to learn before you start spending money. There are books, there are podcasts, keep listening to Aman stuff. I've got 2 books out there. They're $15 each. Do the cheap stuff first. Once you've gone through all the cheap material, then spend some time and find someone that might be a good mentor for you that can help you get into the business. But don't be quick to just jump on somebody's program because they sent you a flashy email or they did some great video or something like that. There's so many gurus out there right now who are just not legitimate. They really don't know what they're doing. So be very careful with all that. And that's why I say spend your time really getting the cheap information. That way you'll be a lot more educated on what a guru, what a mentor should be and would be. Otherwise, all you're doing is going on their sales pitch, and they're really good at sales pitches. So I would not do that. But yeah, cheap information first is what I would tell everybody.
Do you mind mentioning the name of your books?
Sure, absolutely. Let's see. As a matter of fact, I even have them just in case you happen to ask.
Credit Cash,
Real Estate Raw is the first book. I don't know you can see that. Real Estate Raw. This is the book on how to build a portfolio. So you want to start with this book. This is a step-by-step instruction manual on how to build a portfolio. And then I have Creative Cash. And Creative Cash is a book on how to use lease options, seller financing, debt partners, all that kind of stuff. So this is creative financing for real estate. They're both available on Amazon. So you can just type in Bill Ham and it'll pull up. Now it pulls up my books. Used to pull up a dollar bill counter and a Virginia ham if you typed in Bill Ham into real estate. It thought you either wanted meat or to count money, one of the two. Now, finally, Amazon knows who I am. So it'll show you my books. Look those 2 up. My website, realestateraw.com. I have a ton of free info on there, a lot of articles, a lot of videos. Just go there, a bunch of free material. Check out all that free stuff. That's what I'd tell you to do.
So what's your morning routine as entrepreneur?
I don't wake up super early every morning, pretty early. And I read the Wall Street Journal and 2 cups of coffee every single morning. So that's the thing is I use news is for the mornings, right? Mornings are for coffee and contemplation. So I spend my time in the morning reading, catching up on news, things of that nature. And then I kind of get to work around 8:30, 9, something like that, and come to office, start working. But yeah, that's it. Really just kind of do my reading, study in the morning, do all my reading in the morning, every morning, every day.
Nice. And if you have to go back in time and start all over again, what would you do different?
Not much. Probably just try and get into newer real estate, maybe a little bit sooner, maybe a little bigger, a little bit newer, a little bit earlier, but not much. Because I'm here now. And if I had to change something, then maybe I wouldn't be here now, and I'm happy where I am. So.
And if today is the last day on this planet, what message do you want to give to the world?
Whew. Only one more day of this bullshit.
That's a beautiful message.
Yeah. Hey, I don't know, man. If it's one day left on this earth, then I don't know. Don't worry about that newspaper, I guess.
Yeah.
Still have your coffee, but
Still have your coffee.
yeah, I don't know. That's a tough one. Yeah, I think I'm out of here soon. I don't know. I wouldn't know what to tell anybody. Run. I don't know.
There you go. If somebody has to reach out to you, where can they reach out to you?
Absolutely. Email bill@gobroadwell.com. Broadwell Property Group is my other company. And so it's bill@gobroadwell, gobroadwell.com. Feel free to email me, look me up. You can certainly reach out to me through the website, Real Estate Raw. Contact me through there. Facebook, Bill Ham. I'm on all the social media sites. Just look me up.
Perfect. All right. Thank you so much, Bill, for your time. And you explained really great stuff today.
Cool. Thanks, man. Good talking to you again.
All right. Thank you so much. Second episode. All right. Thank you so much, Bill. I'll see you in MM6.
Thank you for joining us on The Real Deal, a commercial real estate investing podcast, the show that covers everything to do with multifamily real estate investing to help you become an expert in your real estate ventures. We're here to help you create passive income and financial freedom so that you can achieve what you want whenever you want. We'll catch you next time on The Real Deal.